A historic move by the Bank of Japan, the central bank raising its key policy rate for the first time in 17 years, yen sliding against the dollar. You also have yields moving to the downside. Now, the Bank of Japan's action coming ahead of the Federal Reserve's decision tomorrow. We want to bring in Kristy Akullian, BlackRock Senior Investment and Portfolio Solutions Strategist. Kristy, it's great to have you here on set.
Thanks for having me.
So let's start with the news out this morning. Bank of Japan, the big headline here. In terms of what this means, ripple effects beyond Japan. Talk to us about how you're looking at this from a strategist perspective.
Yeah, so I think that it's important that we note how momentous the moves were out of Japan that we saw this morning. I know we've talked about it a bit, but the first rate hike in 17 years, a return out of the very abnormal situation of negative interest rates and into positive interest rates. We think that sets a really positive backdrop for Japan and Japan equities. And I think that how investors can think about that more broadly in their portfolio is just another way to maybe diversify away from some of the remarkable concentration that we see in the U.S. equity market. So we're constructive on U.S. equity markets, but we actually see a lot of opportunity for investors to add Japanese equities here as well.
And this is not significant enough to throw off, say, a Warren Buffett who's invested further into Japanese trading houses, we know, in recent years. I mean, this is, and for those who have subscribed to that same kind of Buffettology, if you will, of the markets, this is not enough to throw a wrench in that, right?
No, I think that the broader macro tailwinds that we're seeing from Japan moving out of deflation and into an inflationary regime are enough to offset some of the headwinds that we might see from a stronger yen.
Kristy, this of course comes ahead of the Fed decision tomorrow. A lot of the focus is going to be on that dot plot, what exactly the economic projections are showing. What is your base case at this point? And do you think the market's a bit too optimistic about how many rates we are going to see or the degree of those rate cuts before the end of the year?
Yeah, so I mean, if we go back and even just think about how we came into this year, the market was expecting almost 7 rate cuts. And there was also a 100% chance of a cut, tomorrow in March if we went back to January. Now where we sit, there's about a 0% chance. So as you point out, we're not watching to see if the Fed is going to move. We're watching to see what the dot plots and the expectations of forward policy are going to look like. So, our view has always been that we think that there's probably going to be about 3 rate cuts this year, potentially starting in June or July. I think what we're going to get tomorrow from the Fed and what we're watching to see if Chair Powell can sort of navigate here is leaving himself some optionality. And I think the dot plot is going to show us that we're still probably going to get maybe median 3 cuts here, but I think the risk is that it moves to 2 rather than it moves to 4.
How much does that matter for the equity market?
I think that some of the reaction of that has already been priced in, since we've already seen so many of those cuts come out of the market since, just since January and year to date. But I do think that it can matter for the lower quality parts of the market. So if we look at things like small caps and we look at really highly levered companies, they've struggled a bit this year, and I think they can continue to struggle. So what we prefer instead is really staying, up in quality, up in market cap. We like something like QUAL, is the MSCI iShares Quality Factor ETF. That's performed well last year and this year, and we think it can continue to do so, especially if at the margins we start to see cuts coming out of the market rather than going into it.
Do you think that, and I was looking through your BlackRock weekly market commentary that the team puts out, and it had within there that inflation is likely to settle above the Fed's 2% target in 2025. So with that lead time, what does that spell out for consumer sentiment? What does that spell out for business confidence as well in that near-term period?
Yeah, so I think that there's a few different drivers of inflation happening. What we saw during the pandemic was obviously a supply-side crunch. And so, I think that led to more temporary inflation, and the transitory that, is probably a dirty word now when we look back at it.
You've got it on a t-shirt at this point, yeah.
Exactly. I think that we see some broader mega forces happening in the economy, global economy, that can lead to some of that higher structural inflation. So things like demographic changes are things that we're focusing on for the kind of medium term. I think the more important thing for right now is that we think inflation can be a little bit volatile throughout this, throughout 2024. And so, maybe it's not just when the Fed starts cutting, but how many times this year. And again, it all kind of leads us back to this up in quality trade as being the best place to sort of camp out when there's that amount of uncertainty and volatility that we should expect.
Kristy Akullian, who is the BlackRock Senior Investment and Portfolio Solutions Strategist. Thanks so much for taking the time here in the studio.
Thanks so much for having me.